Thank you, Jonathan, for the very kind introduction, and it's a pleasure to be here this afternoon. I'm especially grateful to the Windsor-Essex Chamber of Commerce for the kind invitation. And you may know that, as was mentioned by Jonathan, I did go to the LSE, and Matt also went to the LSE. So he asked that I tell the story that I just relayed to him before the break about my experience at the LSE. And I was quite fortunate when I was there that Janet Yellen, the current chair of the Federal Reserve Board, and her husband, George Akerlof, who happens to be a Nobel Prize winner, were at the LSE for 2 years, and I was fortunate to take macroeconomic theory with Janet Yellen. So that's a little side note about my background. I'm especially pleased to be in Windsor in 2015, which is the 50th anniversary of the path-breaking Canada-US Auto Pact. The benefits of the pact and the subsequent U.S. trade agreements are plainly evident in the steady flow of commercial traffic here at Canada's busiest border crossing. Windsor residents understand better than most that Canada remains the largest trading partner of the United States. In 2014, the trade between our countries amounts to more than $850 billion, and that's more than 40% of Canada's entire GDP. You also understand that this level of trade is not just a feature of our geography. It is a result of almost 200 years of good neighbor collaboration built on trust, not walls. As a consequence of these cooperative efforts, we have achieved a high degree of cross-border access and economic integration that is truly the envy of the world. And most importantly, it has benefited both countries, both Canada and the United States. Today, I want to talk about cross-border financial collaboration, another key aspect of our relationship with the United States. In particular, I'll examine some cross-border issues that have risen in recent years and explore ways to address them. Now, we all know that a stable, secure, and efficient cross-border financial integration is essential for promoting trade and achieving strong and sustainable economic growth in our two countries. However, the global financial crisis clearly demonstrated that financial systems are indeed highly integrated across countries, but many were inadequately regulated and supervised before the crisis. In Canada, our financial system was and is well regulated and supervised. No Canadian bank failed during the crisis. Now, the strength of our financial system helped us avoid the worst of the crisis, yet we still lost 430,000 jobs and exports plunged by more than 16%. And I'm sure Windsor experienced a lot of that plunge here because you're so close to the US border. Now, that experience taught us a very valuable lesson. In a trading economy like ours, keeping our own financial house in order is not sufficient to shelter us from global financial storms. We need financial stability not just within countries, but across them. Now, the G20 responded to the crisis with a comprehensive global financial reform agenda to first address the weaknesses exposed by the crisis, second, promote global financial stability, and third, enhance financial and economic integration. Since then, unprecedented progress has been made to achieve these objectives. Now, I'll start with an overview of the changes that have made the financial system safer and more resilient. These include reforms to the global banking system and to what is called shadow banking, which refers to a range of financial activities that take place outside the traditional or conventional banking system. Then I'll zero in on two reform areas that need more work to address complex cross-border issues. The first, global banks that are too big to fail. And second, global over-the-counter or OTC derivatives markets, which are immense, approximately $700 trillion US globally, and are critical to properly managing risk within the global financial system. Finally, I'll say a few words about a third policy issue that is essential for supporting financial integration, namely cross-border payments. So let me start by bringing you up to date on the financial reforms. The Financial Stability Board, or FSB, and the current chair is of course, Governor Mark Carney of the Bank of England, who was the guest 5 years ago, and I worked for him when he first became chair. So the FSB is responsible for coordinating the G20 financial reforms, namely developing global regulatory standards and promoting their timely and consistent implementation across countries. Now, working in tandem, the FSB and G20 have made remarkable progress in advancing the financial reform agenda. These efforts have helped to rebuild trust in the global financial system, which was severely damaged by the crisis. Now, a significant accomplishment is the new Basel III framework that has made global banks much stronger and resilient. This framework requires banks to hold more capital and liquidity and imposes a backstop leverage limit. Although the deadline for full implementation of these standards is not till 2019, many jurisdictions, including Canada, are well ahead of schedule. As for shadow banking activities, they represented key sources of financial instability during the crisis. One can easily recall the problems of the subprime mortgages in the United States. That was a key component of the crisis. Now, the FSB is taking a comprehensive approach to monitoring and the assessment of these activities. Now, regulatory standards have been developed through several of them, and implementation is ongoing globally and in Canada, and will be monitored and promoted by country peer reviews that will be conducted this year. Now, the next step is to make further headway on the two areas I mentioned earlier. First, ending the threat of banks considered too big to fail, and second, improving the safety of OTC derivatives markets. The problem of too big to fail was most clearly exemplified by the hugely disruptive failure of Lehman Brothers in September 2008. Now, to address this problem, the FSB has taken three significant policy actions. First, the effectiveness of the supervision of large internationally active banks has been increased. Second, the approximately 30 most systemically important global banks, those so large that their failure would have an impact on the entire financial system, have been identified, and they will have to hold more capital in the future to make them safer. At this point, there are no Canadian banks on this list. In Canada, however, the Office of the Superintendent of Financial Institutions, which I'll refer to by its acronym OSFI, has identified 6 of our banks as systemic at the domestic level as opposed to the global level. OSFI has mandated that they hold 1% more capital and has strengthened its oversight of them. Third, and perhaps most significantly, the FSB has developed a set of policy standards to resolve these large banks when they become non-viable. Essentially, what these imply is that these banks should be recapitalized by bailing in their private debt holders, who will then become shareholders, rather than being bailed out by taxpayers, which occurred during the crisis. This restructuring will help ensure that the bank remains a going concern so that critical functions such as deposit taking, payments, and lending can be maintained and the financial system not be disrupted. However, because these globally systemic banks operate in many jurisdictions via subsidiaries and branches, we need to tackle a number of challenging home host questions. In particular, whose rules will govern the resolution? Those of the parent bank, the home jurisdiction of the parent bank, or those of the host jurisdiction of the subsidiary bank or branch? Where will the capital to absorb the losses be held? In the parent bank or in the subsidiary? How do we ensure cross-border financial contracts like OTC derivatives are maintained and not torn up in resolution? Now, the FSB is methodically addressing each of these important questions and making solid progress. In the meantime, there's a risk that some countries, understandably concerned about the safety of their own financial systems, may take measures that run counter to the spirit of the G20 reforms to enhance financial integration. For example, from a Canadian perspective, the set of rules governing foreign bank operations in the U.S. Dodd-Frank Act of 2012 are about to be implemented, and they will have implications for Canadian firms. Under Canadian banks, under Dodd-Frank, subsidiaries and branches of international banks of a certain size will have to meet separate capital and liquidity requirements in the United States. Well, what does that mean for Canadian banks? Our largest banks have sizable U.S. operations. Some will likely meet this size threshold and will be subject to these new requirements. These national rules will not only impose legal and administrative costs on our banks, but might also constrain their ability to allocate capital and liquidity efficiently within the North American market. And if a Canadian bank with U.S. subsidiaries were to fail, it bears asking whether the preemptive actions of U.S. authorities would create obstacles for the consolidated bank's orderly resolution by Canadian authorities. This one-size-fits-all approach to foreign banks overlooks, first, the existing degree of integration of our two economies. Second, Canada's impressive record for financial stability. And third, the fact that Canadian banks have long been active and well-trusted in the United States. Other things being equal, the cost of these duplicative regulatory requirements will be borne by customers and owners of Canadian banks on both sides of the border. That is, in brief, where we stand at the moment on cross-border banking resolution issues. As you will see in a minute, the cross-border issues related to OTC derivatives are equally complex. Now, OTC derivatives or swaps are derivatives trades between two parties without the involvement of a formal exchange. Now, to give you an example, suppose you went to your bank and asked for a loan. Typically, that loan would be a floating rate loan. If you wanted to protect yourself against the risk of an interest rate increase, you would want to convert that floating rate loan into a fixed rate loan. And to do that, you would actually have to undertake an over-the-counter derivatives transaction with your bank. And so that transformation of a flexible rate loan into a fixed rate loan would involve an OTC transaction. And those types of transactions, what we call interest rate swaps, are the largest type of derivative contracts that exist presently in the world. Now, before the crisis, these types of contracts were largely unregulated. For example, when Lehman Brothers failed, it had roughly 1 million outstanding contracts. And no one outside the company knew how much Lehman owed or to whom. And so that's why the failure was so disruptive. As a result, uncertainty rippled through the market, spreading fear about the solvency of other banks and impairing the functioning of core markets. Now, this experience has highlighted the interconnectedness within markets and how the failure of one institution can pose a systemic risk that affects the entire financial system. Under the G20 reforms that aimed at reducing systemic risk, countries have agreed to a number of new measures. These include reporting all the transactions to data storage facilities known as trade repositories. Authorities will be able to use these data to analyze risk exposures and better understand the connections among financial institutions. They also agreed that all standardized contracts would be cleared through central counterparties. Now, these central counterparties serve as intermediaries in the transaction, and so they greatly reduce the risk of default of either party. Again, much progress has been made on improving and reporting central clearing of transactions. The challenge ahead is to ensure that the rules for on-the-ground implementation of these reforms are consistent across jurisdictions. Now, to understand how complicated this is, it is helpful to recall that OTC derivatives were largely unregulated before the crisis, and the United States was the jurisdiction most affected by it. So it was the first to implement the G20 reforms with the Dodd-Frank Act. Now, other countries were slower to respond, and this led to differences in implementation, especially amongst the major jurisdictions. These differences are only now slowly being resolved. In the meantime, market participants are trying to cope with these regulatory inconsistencies. As a consequence, the costs of cross-border trades are rising and global markets are starting to fragment. Canada and other jurisdictions are caught in the middle. Now, one of the ways countries are managing these differences is by recognizing each other's regulatory approaches when they achieve similar prudential outcomes. In this regard, the U.S. Commodity Futures Trade Commission, which is taking the lead on OTC rulemaking in the United States, has recognized that OSFI's requirements are equivalent to those of the United States in several cases. However, the Commission still wants Canadian banks to submit to its oversight, which could include on-site visits in Canada. Now, Canadian and U.S. authorities are working together to limit the additional burden this places on affected Canadian banks. So to summarize, national authorities should strive to build trust and achieve more cross-border recognition of each other's rules regarding OTC derivatives. Such an approach would reduce regulatory uncertainty and enhance the ability of market participants, ranging from global banks on one hand to small factory owners and farmers on the other, to hedge risks and protect themselves from economic shocks. Now let me now turn to cross-border payments, an issue I'm sure all of you have likely had some experience either as consumers or in your businesses. As you know, sending funds or receiving them from the United States is slow, inconvenient, and costly. And you won't be surprised to hear that in a recent report by the Federal Reserve, they describe cross-border payments in much the same way. And you'll be pleased to hear that the Fed and the Banque du Canada are working with the financial industry to promote efforts within their respective jurisdictions to modernize cross-border payments. In its report, the Fed argued that the U.S. payment system is at a critical juncture because of three factors. First, technological advances in high-speed data networks. Second, the related need to ensure the safety and security of payments. And third, user demands for less costly domestic and cross-border payments, manifested by the growth of other means of payments, such as PayPal. To improve cross-border payments, a number of key barriers need to be addressed. They range from regulatory requirements for anti-money laundering rules to a lack of standardization of electronic formats. Standardizing the formats would allow more business information to be transmitted with payments. Now, these barriers are not easy to overcome. Resolving them, however, will significantly increase efficiency and greatly reduce the costs of cross-border payments that we all often have to make. So what can we do to overcome these challenges to cross-border financial integration that I just described? The ideal, of course, would be to have broad agreement across all G20 members. But securing a multilateral compromise could take several years. Still, we should not abandon this possibility. The FSB has helped build trust through its consensus-forming processes and should continue to press for the timely development and consistent implementation of new global standards. In this vein, we should urge the U.S. and other authorities to respect the G20 leaders' agreement at the 2014 Brisbane Summit to defer to each other's regulatory requirements when they achieve the same prudential outcome. If this were to occur, Canada would clearly benefit, given its strong and crisis-tested regulatory and supervisory framework. At the same time, it would be wise to consider alternative approaches. For instance, Canada and the United States should consider the option of a bilateral agreement on the resolution of banks with cross-border operations in order to clarify responsibilities and enhance cooperation. We have a long history of stable and financial integration, and U.S. financial institutions and legal frameworks are similar to ours. So that if any two jurisdictions could achieve such an agreement, it should be Canada and the United States. We could set an example for other countries. In this regard, the 1988 Free Trade Agreement between Canada and the United States offers a useful precedent. It served as a template for other regional trade agreements at a time when multilateral trade negotiations were making little headway. On cross-border payments, we should come to terms on more efficient arrangements, including harmonizing anti-money laundering and other standards, reducing processing times, and establishing direct links between our two respective systems. We could, for instance, explore opportunities to enhance the existing Fed Global program for cross-border payments, which is currently limited to northbound transactions only. Let me conclude with a few words of wisdom from a great American poet. In his poem, Mending Wall, Robert Frost questions his neighbor's belief in the old adage that good walls make good neighbors. Instead, Frost writes, before we build a wall, we should first consider what we are walling in or walling out. The message I take from Frost's words is good neighbors should work together to build trust, not walls. Canada and the United States have a long-established economic and financial ties, built on trust, that have served both countries well. Today, we have a unique opportunity to advance the global reform agenda in the critical but thorny cross-border areas of bank resolution, OTC derivatives, and payments. We both have much to gain by strengthening financial integration between our two countries. More efficient cross-border financial services will facilitate more trade, and more trade will contribute to stronger economic growth in both countries. Merci pour votre attention. Thank you for your attention. I would be happy to answer any questions you might have. Thank you. Yes, please.
Thank you. Can you comment on the Canadian dollar and where you see it going over the next year or so?
Canadian dollar. I get that question often, so I'm well prepared. We don't make forecasts about the Canadian dollar, but what our studies show very clearly that what determines the Canadian dollar are really two factors. It's commodity prices and the adjustment of the US dollar. So if the US dollar is moving relative to all other trading partners, it'll typically affect us. The same story was with commodity prices. If commodity prices rise, the Canadian dollar will typically appreciate. If commodity prices go down, it will depreciate. So what we've seen, for example, over the last year is that oil prices have dropped by 50%, depending on how you measure it. That clearly has had an impact on the value of the dollar, bringing it down by about 10 cents US over the same period. So if you can forecast commodity prices or forecast what's happening to the US dollar, that gives you the best sense of what's happening to the Canadian dollar. At this moment in time, we feel that commodity prices are relatively stable. We think that as the global economy rises, that should provide some strength to commodity prices. And the US economy is starting to pick up steam as well, so that's going to have an effect also. So it's really those two factors that are responsible for affecting the Canadian dollar.
Want to comment on the Greek situation and what would a Greek collapse mean to the economy and
Well, the Greek collapse. I mean, I want the Greek collapse is, my view, is not likely to occur. I think my sense from the discussions this week is that saner heads are prevailing, and that an agreement will be reached between the European authorities and the Greek authorities. This situation with Greece has been ongoing for a number of years. If it were to happen that Greece were to exit the Eurozone, I think that preparations have been put in place to withstand that outcome. Canadian financial system is relatively insulated with respect to Greece, so I don't expect a large impact here. The other important thing to keep in mind is that the European economy is showing some strength. Their financial system has been rebuilt and repaired, and so I think they're in better shape. But as I said, my bottom line is I think that the Greek authorities will recognize that the Greek people want to stay in the Eurozone, and they'll find a way to come to an agreement.
Larry, thank you very much for that. That was very, very insightful. I actually have a couple of questions. So one, we talked about cross-border payments and the importance of them to facilitate trade between not only Canada and the US, but also our North American partner in Mexico. I'm wondering if the Bank of Canada has done any work on the potential unionization of a North American currency that would help to facilitate trade amongst all three of our countries.
Mm-hmm. Well, we've done research. I mean, I was intimately involved in this research about 10 to 15 years ago. At that point, we still feel today that having a flexible exchange rate allows us to insulate the Canadian economy from shocks that arise from the outside. For example, the oil price decline I just mentioned. If we didn't have a flexible exchange rate, the impact on the Canadian economy would have been much more severe. So what's happened over the last last year or so is the dollar's depreciated by 10 cents, and that's helped to buffer the impact of the falling oil prices on the Canadian economy. We see resources shifting within the Canadian economy, and some of them, and we're seeing more strength in Ontario to compensate for the fact that oil production and investment is declining in Alberta. So that kind of adjustment is facilitated by the flexible exchange rate. The other important consideration is the fact of having a flexible exchange rate allows us to have our own domestic monetary policy, to choose our own inflation target. If we were to have a common currency, we'd have to decide together on what inflation rate would be. And you can see that these can create big differences. If you look at what happened before the crisis in Ireland, they were experiencing inflation rates of 6% because they had one monetary policy for the entire Eurozone region. So it wasn't targeted to specific countries. And so the advantage of having a flexible exchange rate, it allows us to choose the inflation rate that Canadians feel is most appropriate.
Yeah, interesting. One very last question.
Sure.
It's one that really hits home for us as Canadians. So, increasingly more and more Canadians are placing their wealth in real estate as a result of, what seemingly unsustainable rising consistent growth in housing prices. I'm curious from the bank's perspective, what is your view on the housing market nationally? Where do you see it going? And would you suggest that that could impact adversely the stability that we have in the Canadian economy? Thank you.
Very good question. In our most recent financial system review that the bank released in June, we identified two key domestic vulnerabilities. One was the housing market, and the second was the fact that Canadians have become heavily indebted in part because they've devoted a lot of their debt to buying houses. And so that is a concern. Now, the fact is that if you look internationally, a lot of countries have experienced the same experience with housing prices that have gone up fairly dramatically. Now, what's interesting is I think that in many advanced countries, as wealth and incomes increase, residents seem to want to demand more housing, and so that's driving up housing prices. Now, if you look at Canada at the moment, the way we've characterized the housing market in the financial system review is that it's trifurcated, or there's three speeds. That if you look at, for example, Alberta or Saskatchewan, other oil-producing regions, the rate of increase in house prices is actually decelerating close to zero. So we're getting a deceleration there, what we like to call a soft landing. And at the other extreme, we have jurisdictions like Vancouver and Toronto where house prices are going up relatively quickly. Now, part of the explanation there is, in particular Vancouver, that the supply of land is relatively fixed. And so if you have an increase in demand, that's naturally going to push up house prices. And there's also a question of the fact that Canada allows 300,000 immigrants into the country a year, and roughly half of those go to Toronto, and a good portion go to Vancouver. And so those people arriving in those municipalities are going to demand housing. So that's constantly going to push up house prices in an environment where the supply of housing is relatively limited. So that's the other extreme. So we have Alberta and Saskatchewan, and to some extent Newfoundland, where there's oil producing activities, and those have declined, and so house prices are starting to decelerate there. And if you look at the rest of Canada, for example, in Ottawa, where I live, and in jurisdictions even further east, in municipalities further east, house prices are essentially flat. So they're achieving what we might call a soft landing. So it's really this market that we have in Canada that's a regional market that's going at 3 speeds. So over time, we expect that as the Canadian economy strengthens, we all know that interest rates will eventually start moving up. That will work to cool the market and will achieve what we call a soft landing, where nominal prices will stabilize. And so I think that's how that vulnerability will become eventually addressed. Any questions? Well,
Any other questions? Oh, one more.
sorry.
Can you explain to us what you know about the Ontario Hydro, the IPO that they want to sell, and how it's going to affect Ontario?
I think that's an important question for Ontarians to ask. I've lived in Ontario all my life, and I'd like to know the answer to the question. Fortunately, that's something the Banque du Canada doesn't really study closely, and it's well outside our remit. But I think it's a very important question for Ontario. I can't really comment. I'm sorry.
On behalf of the Board of Directors, Deputy Governor Lawrence Schembri, we really appreciate you coming here, spending your time with us, and answering questions from our community. So we have a small donation to Epilepsy Canada, which will be made in your behalf. So thank you very much.
Thanks, Dan.